Royal LePage says most Canadians with mortgage renewals this year are bracing for a hit to their finances. A survey by the real estate company shows 57% of 1,300 homeowners expect to face higher monthly borrowing costs.
What happens when the banks that held up Canada's entire housing boom for 2 decades suddenly start contracting their mortgage books at record speed? What happens when arrears climb while lenders simultaneously pull back from the very market that made them billions? And what happens when a provincial premier watches his entire economic strategy crumble in real time because the financial institutions he counted on are now in full retreat mode? This isn't a warning about something that might happen next year. This is happening right now across British Columbia, and Premier David Eby is watching the mortgage system that powered Vancouver's real estate market completely disintegrate before his eyes. Subscribe right now and smash that like button because what I'm about to reveal shows exactly why. Canada's banks are experiencing record mortgage contraction while arrears surge to levels not seen since the 2008 financial crisis. The numbers coming out of Canada's major banks are absolutely terrifying, and almost nobody in mainstream media is connecting the dots. Canadian banks just reported the largest mortgage portfolio contraction in modern history. We're not talking about slower growth. We're talking about actual shrinkage. The total mortgage book across Canada's big banks contracted for the first time in decades, and the pace of that contraction is accelerating every single quarter. At the exact same time, mortgage arrears are climbing at rates that should alarm every homeowner, every investor, and every government official in the country. Banks don't contract their mortgage portfolios during stable economic periods. They contract when they see something catastrophic coming, and they're desperately trying to reduce exposure before the wave hits. Premier David Eby built his entire housing strategy around the assumption that financing would remain available, that banks would continue lending, and that developers could access capital to build the supply British Columbia desperately needs. Every single one of those assumptions just exploded. The banks are now signaling through their actions, not their words, that they believe the Canadian mortgage market is heading toward a crisis that makes 2008 look manageable by comparison. And when banks start pulling back at this speed, it creates a self-fulfilling prophecy where reduced lending availability triggers the exact crisis they're trying to avoid. Hit that like button because the arrears data I'm about to share proves this crisis is accelerating faster than government officials are willing to admit publicly. Mortgage arrears across Canadian banks have climbed 2 levels not seen in over 15 years. These aren't subprime borrowers or speculative investors. These are prime borrowers. People with good credit scores, stable employment histories, and reasonable debt-to-income ratios when they originally qualified. But 2026 mortgage renewals are hitting these families like a financial sledgehammer. Someone who locked in a rate at 1.79% in 2021 is now renewing at 5% or higher. That single rate change transforms a manageable $2,800 monthly payment into an unbearable $3,950 payment. And when you're already spending 106.3% of your income on housing costs, as the average Vancouver household is, there's simply no room to absorb that increase. The banks see this data in real time. They know exactly how many mortgages are renewing in 2026. They know exactly how many households can't afford the new payments, and they're responding by aggressively contracting their mortgage exposure before the defaults begin hitting at scale. This isn't speculation. This is risk management. And when Canada's most sophisticated financial institutions are managing risk this aggressively, it means they have access to data that terrifies them. Data they're not sharing publicly because releasing it would trigger immediate panic. Subscribe now because what's happening in British Columbia is the blueprint for what's coming to every province across Canada. Premier Eby's government is caught in an impossible position. They need housing supply to increase dramatically to address affordability. But housing supply requires financing. Developers need construction loans. Buyers need mortgages. Investors need leverage. The entire system runs on debt, and the banks that provide that debt are now in full retreat. When banks contract their mortgage books, developers can't secure construction financing even for approved projects. When buyers can't get mortgages, completed units sit unsold. When investors can't access leverage, pre-sale markets collapse. The entire ecosystem depends on flowing credit, and that credit just stopped flowing. The psychological impact is devastating. For decades, Canadians believed real estate was the safest investment possible. Buy property, wait, watch, values climb, refinance, repeat. That entire model depended on perpetually available financing at reasonable rates. But when banks contract their mortgage portfolios while arrears surge, they're sending an unmistakable signal. The old model is dead. The assumptions that powered 2 decades of real estate appreciation have broken, and the institutions with the most sophisticated risk models in the country are positioning themselves for a collapse they believe is now inevitable. Drop your thoughts in the comments, because the timing of this contraction reveals exactly why 2026 will be remembered as the year Canada's housing market crossed the point of no return. The convergence is what makes this catastrophic. Mortgage renewals peak in 2026. Bank lending contracts in 2026. Arrears surge in 2026. Developer insolvencies accelerate in 2026. And all of this happens while 100,000 approved projects across Metro Vancouver sit stalled because the financing ecosystem has completely broken down. Premier Eby can announce housing targets, change zoning rules, and streamline approvals all he wants. None of it matters if the banks won't lend. And the banks have made their decision. They're pulling back at record speed because their internal models show something so alarming they're willing to sacrifice billions in potential revenue to reduce exposure. Now, the historical parallel is unavoidable. In 2007, major banks started pulling back from mortgage markets months before the public understood how severe the crisis would become. By the time mainstream awareness caught up, the damage was already irreversible. We're watching that exact pattern repeat right now in Canada, except this time the leverage ratios are higher. The household debt levels are more extreme, and the proportion of variable rate mortgages is far more dangerous. When this wave hits, it won't be a correction. It will be a generational reset that reshapes Canadian real estate for decades. By late 2026, economists and historians will look back at this moment and ask how so many people missed the warning signs that were flashing everywhere. Record mortgage contraction, surging arrears, developer insolvencies, stalled projects, infrastructure deficits, and a provincial premier watching his entire housing strategy collapse because the financial system he depended on just pulled the plug. The banks see what's coming. They're preparing. The question is whether anyone else will prepare in time, or whether millions of Canadian families will be caught completely exposed when the system finally breaks. So here's my question for you. Can anything stop this banking contraction from triggering the mortgage crisis that destroys British Columbia's housing market? Or are we already past the point of no return? Are you facing mortgage renewal in 2026? Has your bank already started changing the terms of your relationship? Share your experience in the comments right now, because the stories emerging from across Canada reveal just how widespread this crisis has already become. Don't forget to subscribe and turn on notifications, because what happens over the next 6 months will determine whether Canada experiences a controlled adjustment or a complete financial catastrophe. And you cannot afford to miss a single update. I'll see you in the next one.